Welcome to the Newton Knowledge Podcast. My name is Mark Singer, partner of Newton One Advisors. As always, we aim to provide meaningful content to our valued advisor community and clients who are interested in learning more about sophisticated insurance-related topics, focusing on estate planning and executive benefits. We focus our discussions on content that will deliver unique insights into the people, processes, and products that make our industry so critical. Newton One is a national life insurance planning firm delivering customized insurance solutions structured to help clients and their advisors engaged in solving estate planning, wealth transfer, business succession, and executive benefits challenges. We are a member of the M Financial Group, offering our clients access to the nation's most prestigious insurance carriers and innovative products available only through our network. Today's topic is insuring unique assets, and our guest, quick note, before that, we try not to go over 30 minutes per episode. So if I read the bio that was sent over, which was very impressive, we'd be left with about 2 to 3 minutes to hit the meat and potatoes of this topic. So here's the abbreviated version for my very good friend, Brian Travers. He is a senior private client advisor with Brown & Brown Private Client Group. Brian's an expert in that field with over a decade of experience in developing risk management solutions for successful individuals and families. He's truly passionate about creating solutions that help his high net worth clientele protect their most valued assets and manage their unique risks. Brian holds his bachelor's in business administration, finance, and risk management from St. Joe's University, Philadelphia, where he is one of the inaugural participants in the school's risk management and insurance program. Brian has his chartered private risk and insurance advisor designation and is pursuing his chartered property and casualty underwriting deg as well. It's taken way too long to have you on here, Brian, with our 14th episode. So welcome, and how are you today on this rainy and miserable-looking day, unfortunately?
Well, Mark, as rainy as it is, it's always a pleasure to be in the presence of you in the Newton One office here in Newark, Delaware. So I'm pleased to be here. It's my first podcast experience, so certainly hope it goes well, but I'm very honored to have the opportunity to be on here today.
I have no doubt in my mind that you'll be a pleasure to have on and be fantastic at this podcast experience. And this is your first time in the office.
It is my first time, so a lot of pressure to record this session, but we'll have some fun today.
All right, should be a good one. So, working closely together for the past few years, I have a feeling your response to my first question will have some similarities in regards to how I would respond. Fundamentally, not so much from a technical standpoint for, we provide advice on different solutions, but we do have similar clientele as well as our white glove process, if you will, and strategic approach in certain engagements. That said, tell our audience about your work specifically, the services you provide, your focus, and the discussions you enjoy having with your clientele.
Sure. So at Brown & Brown Private Client Group, our firm's sole focus is protecting what our high net worth and ultra high net worth families have spent really a lifetime building. Specifically, we're a full service independent property and casualty insurance brokerage firm focusing on personal risk management for our affluent clientele. We specialize in risk transfer via traditional insurance products, along with risk avoidance and mitigation via proactive guidance for our clientele. So, with respect to personal insurance, we offer products and services in all 50 states and internationally. Our services and products range from covering traditional assets such as homes and vehicles, art, jewelry, or any really tangible asset that a high net worth client is interested in collecting, to some more unique ones such as watercraft, aircraft. We get involved in travel, kidnap and ransom, and much more. So really the full suite and breadth of services that a high net worth client would need. From a service perspective, we also partner with third-party firms as well as insurance carriers to provide services to clients to help prevent a loss from occurring in the first place. So for example, that can include contents and fine art, inventory, management and valuation. We get involved with wildfire and hurricane prevention services. So there's a lot on the table from a service perspective that we get involved with. And as it relates to our process, our goal is to first and foremost become a trusted advisor to our clientele. So this really requires taking the time to sit down and understand the client's goals and objectives in their lives, their individual tolerance for risk, and what their truest, greatest concerns are when they contemplate their day-to-day risk. Everyone has a different perspective on what that is when it comes to risk, right? So some rely heavily upon traditional insurance products, while others are more open to kind of more proactive risk management and avoidance, or even self-insurance. So ultimately, our goal is to simplify the transactional nature of insurance while also bringing peace of mind to our clients.
Well, the one thing that comes to mind is you said wildfires. So right away I thought of California and some of the unfortunate things that have happened there over the past couple of years, along with what's happened in Florida. And the loss of life is extremely sad. I can only imagine these circumstances having a significant effect or impact on your industry. Is that so? And if so, please elaborate.
Of course. So naturally, we're in the property protection business, right? So we have many clients who love the sunny weather that Florida offers, and obviously it's a beautiful state to live in. But with that, as we all know, there's the potential for hurricanes and natural disasters, flooding, and all of those terrible incidents to happen. So we're fresh off Hurricane Ian making landfall in the southwest coast of Florida. Made initial landfall in the Captiva, Fort Myers area as a Category 4. It was, I think, 2 or 3 miles an hour short of a Category 5 hurricane when it made landfall. So in our industry, what we would consider nearly a 1 in 500 year event that occurred. When we consider hurricanes, we think of the southeast of Florida, right? We have Miami, Palm Beach. Those are traditionally the areas that are impacted by an event like this. So for it to come up through the Gulf, over Cuba, make landfall on the West Coast is certainly led to an even more unfortunate result that we're seeing. So the initial estimates are that insured losses could potentially exceed $50 billion from this event in a marketplace that's already struggling and seeing some challenges. So market capacity is a significant challenge in Florida right now. So carriers are either pulling out of the state entirely or financially being downgraded due to some of the losses that are being incurred in the state. Many of which are driven by legal expenses, which we could talk about another time. So, really this event's only going to further tighten up capacity and availability of coverage in the marketplace, specifically for wind and flood cover. And obviously our clients are the ones who could potentially be impacted the most, as their homes are in areas that insurers are currently taking the greatest hits at. So, we'll see this develop, but I would anticipate that this will further kind of put a challenge on coverage placement in that state.
I mean, you bring up a good point. Depending on where you're located, wherever your second home may be or your vacation home, are there, so in the disability world, say, if you have a certain medical history or ailments, they may put exclusions on certain products that you wouldn't essentially be covered for due to the risk. Now, is that somewhat similar in your world? If your home's located, say, in Tornado Alley or in Florida, and from a flooding standpoint, are there restrictions and limitations on certain policies and coverages due to the location of the home?
So yes, the short answer is yes. I will say that our business is heavily regulated. So every insurance carrier operating on what's called an admitted basis in the state has to file their rate and form with the state insurance department. So if they wanted to file some sort of coverage exclusion on the policy, that would need to be sent to the state, and the state would need to approve it before it would ever be implemented. So what you typically see in high-risk areas such as Florida or catastrophic-prone areas is that a lot of the coverage options in those states are actually through what's called the non-admitted or excess and surplus market. So those are markets that are not regulated by the state insurance department. They can really customize the policy contract, the wording, the exclusions, the rating, and all of that to really meet the needs of the end client. Just understanding that obviously the coverage may be a little bit more limited. So for example, you may have a homeowner's policy that excludes wind. Most homeowners insurance policies exclude flood as it is, but certainly in Florida, wind is a significant peril, and a lot of clients do elect to self-insure the wind exposure and purchase an X wind insurance policy. So yes, there are ways to customize policy coverages to kind of carve out that greater risk.
What would you say day-to-day makes up majority of the assets you insure?
Well, often when a client comes to us, there's a specific need driving that initial conversation. So, what we see in our business, unfortunately, is that we're a relationship-driven business. So when a client is kind of on the early part of their career or in their life, they may know an insurance professional in their network that they prefer to use. And over time, as they acquire wealth and advance in their career, they don't often go back and kind of re-review the insurance portfolio. And unfortunately, what that leads to is, them outgrowing their portfolio and their relationships. So where we typically see the initial conversation occurring is when they're acquiring some new asset and their current insurance agent or broker can't accommodate coverage placement. So, for example, a home in a high-risk area, such as a beachfront property, if the client's with a direct writer insurer, they may not write coverage in that state or certainly not in that area. So that's typically where we get involved, with a new client relationship. To answer your specific question, the homeowner's line of coverage is usually the one that drives the conversation. There's some sort of transactional incident occurring that leads us to get introduced to the client and assist. So the most common assets we're providing cover for are really tangible property. So homes, whether that's a primary, a secondary, or a seasonal home, an investment property, a rental property, vehicles. So that could be private passenger vehicles, collector cars, antique cars, motorcycles, ATVs, even e-bikes and e-scooters now are getting more popular. Traditional contents in the home. So that'd be your furniture, clothing, small appliances, all the things that are inside the house itself, along with kind of valued and cherished collections. So our clientele have the means to diversify their asset portfolio, and people are into different things, right? I'm into wine myself, but we have clients that are into artwork or jewelry or spirits or all sorts of things. So anything that has a potential for physical loss, more or less, can be insured. So and then of course liability, which is a separate topic. That's not a tangible property, but liability is probably the most critical component of a risk management program.
Liability. If you don't mind touching on that a little bit, since it's a huge component of your practice, that would be great.
So liability is, when we think of a high net worth or an ultra high net worth client, liability protection is first and foremost the most critical aspect of a called insurance or risk management program. Obviously, homes and vehicles and other tangible property would be a significant loss if they ever were to face a total loss occurrence. But when you think of what is truly on the table from a client's net worth and assets, it's the risk of them losing everything in a catastrophic liability loss. So, that could be a vehicular accident leading to severe injury or death. It could be a injury at one of their homes. They could be hosting a party and someone maybe had a little bit too much to drink and left, and they were to kill someone in a car accident, and now our client is being brought into a suit for that. So these are all kind of things that our clients face. And our clients are high profile. A lot of them are celebrities, athletes, white collar executives that have more of a presence in the media and are more readily Googled, if you will. So if an incident occurs involving one of them, the plaintiff's side understands that there's assets to go after, right? So that's our client's number one concern, is liability. And we get the question all the time, well, what is the right limit of coverage to carry to kind of protect my net worth and my future generations' kind of wealth preservation? And, that's something that, we could touch on a separate time, but, we look at, what are the current assets in play? So there's tangible assets, there's investments, there's cash, there's retirement accounts, and all of that, as well as projected future earnings could be brought into an issue. So it's a deeper conversation than just picking a number out of a hat.
It's very interesting. From an underwriting perspective, and on our side, we deal with actuarials suggesting one's mortality based off their past, current, and supposed future health status, if you will. What does the underwriting process look like in your world? Is there a valuation process that's involved, or how does that unfold?
Yeah, so when it comes to underwriting, most carriers on the surface are generally looking for the same information. So first and foremost, who is the insured, right? They want to know who they're insuring and specifically what they're insuring. So what property are they looking at? They're looking for physical characteristics of the property being insured, such as construction type, year built, the geographical location. Obviously, they're looking at the limits being insured, a client's prior claims or loss history, their digital profile, their occupation, and they're even looking at a client's credit history. So numerous studies have actually shown that poor credit is a predictable indicator of future insurance losses. And it's actually now approved in nearly every state to use as an underwriting mechanism. So pretty interesting, which certainly for our clients, a lot of them pay in cash, right? So, sometimes we do come across that where maybe the credit profile is not as superior because of, some other mechanisms in play. So in the high net worth marketplace, who the insured is critical. So obviously, like I said before, we're insuring very well-known public figures such as athletes, celebrities, executives, many of whom have a high profile and are often represented regularly in the media. The higher the profile of the client, the greater potential risk to the insurance carrier, as they can easily be brought into a lawsuit that can go awry. So carriers in our space typically offer no cap on defense costs or legal expense in the defense of a lawsuit. There was a very well-known lawsuit probably a little over a decade ago that I won't specifically name names, but a very well-known actor was brought into a sexual abuse allegation suit, and the insurance carrier on the homeowner's side was actually brought into that suit from a defense perspective, and millions of dollars in legal expenses were incurred from that claim. So kind of going back to my point, who the insured is, they want to know who they're underwriting and who they're offering cover for. And then finally, they're really keen on understanding what a client has done to prevent a loss from occurring in the first place, or if they've had a loss or a claim, what they've done to prevent it from happening again in the future. So for example, if you have a client that had suffered a pipe burst or a leak in their home, what could be done to prevent that from happening again down the road? It's been shown that if you have any type of non-weather related water damage loss, you're much more likely to have another one. So we proactively would recommend the installation of an automatic water shutoff valve, which shows to the carrier that the client's taken a proactive approach in protecting their property and ensuring something like that doesn't happen again, rather than just relying on the insurance policy and saying, well, I have insurance, it'll be covered. It truly shows pride of ownership in that they're taking a vested interest in protecting their property.
No, that's great. And, as I think about, aside from the liabilities, more so the tangible assets, my mind naturally transitions to the estate planning side, hearing about, the valuation potentially of one's net worth when aggregating all of these assets. So when the dust settles, these prized possessions make up a descendant's estate, and estate equalization being a part of our practice. Life insurance policies for years have assisted privately held business owners, providing an immediate liquid transfer of value to certain heirs that may not be involved or gifted equity of the business endeavors. In your case, the question turns to who's receiving these luxury cars or oceanfront shore houses as your relationship grows and with such successful families and their businesses and their assets grow. Is this part of the discussions you're having or diving deeper regarding estate preservation and generational transfer?
Well, I'd like to think I have a pretty good relationship with my clients, and I'm hoping one of these days I'm the one that's gifted the luxury car or the oceanfront shore house for such great service. But realistically, we're fortunate that our clients are relatively sophisticated when it comes to estate planning. So in our case, we're typically introduced to the next generation much earlier on in the process. We typically will insure the assets of the children of the client as well as the client's assets. And the children are most often the ultimate recipients of those assets upon death of the insured. So when we manage the portfolio of the next generation, the insurance placement upon the death of the client becomes much easier to manage. For example, we already have a relationship with the client and their children. We already have experience with the risk being insured, which makes the coverage placement easier in the ultimate event of that occurring. Conversely, when we're brought into a conversation at a much later date, that one asset that's been transferred to the next of kin may be the only piece we're being asked to write coverage on, which presents an issue and makes it much more challenging to find coverage placement when we're not looking at the whole entire portfolio. So kind of establishing an earlier relationship with the next generation certainly makes that asset transfer process much easier for all parties. Your second question related to
discussing estate preservation and generational transfer.
Right. So, the biggest concerns we hear from our clients as it relates to generational transfer is the next generation going to cherish or value the asset as much as they have? So when you think of valued collections and passion assets, for example, a piece of artwork that's been in the family for over 50 years, our clients are concerned, do their children even want to keep the piece? Or are they going to just turn around and try to sell it? So, they really want to have a firm understanding of who wants the assets upon death, who will take care of it, who will protect it, And will they rely upon the same expertise in us that they themselves have relied upon for many years?
No, that's a great point. And a lot of our clients, from a transfer perspective, outside of their own estate, are charitably inclined. And when gifted appropriately, the tax advantages can be huge. What are the top 3 hurdles you and your team come across and must overcome when insuring certain assets?
I think my answer to this question would be totally different 5 years ago. But obviously, I'm looking at it from the lens of today's perspective. So, first and foremost, it's going back to a point I made around Florida. It's definitely market capacity. So the insurance marketplace is going through what's known as a hard market. Essentially, rates are rising, coverage availability is more scarce, underwriting is much tighter due to kind of increase in loss costs, loss severity and frequency, things of that nature. So in addition to that, we're seeing significant patterns in losses. So for example, weather events such as wildfires out west, flooding across the country, including in areas that are not designated as special flood hazard areas or high risk flood areas. So I think the stat is 35% of all flood losses occur in a quote non-hazardous flood zone or flood zone X. So little tidbit, if anyone ever says I'm not in a flood zone, that's actually incorrect. Everybody is in a flood zone. It's just a matter of, are you in a high risk zone or a low risk zone? So, and traditional weather events such as we just talked about Hurricane Ian in Florida. So you have all these kind of weather impacts going on that are not anything that we haven't seen before. But on top of the geographical pressures carriers are seeing, you're also seeing external pressures such as supply chain issues, lack of skilled labor, the current inflationary market, driving up claims costs, along with the phenomenon of non-weather related water damage. So that's any type of water damage in a home not caused by a weather event such as a storm or hurricane. So, and actually on that point, to touch on that, it's estimated that 1 out of every 2 claims that occur in a client's home is due to non-weather related water damage. And the average claim now is over $66,000 to repair. And the most recent stat is 95% of those claims are actually preventable or largely mitigated through some loss mitigation measures. So, we talked a little bit about proactive guidance. There's things we could do as an advisor to inform our clients on, hey, how do we, obviously the insurance policy would cover something like this, but how do we prevent it from ever happening in the first place, to where you and your family aren't displaced from your home for 3 months, having to rip up your floors, you have potential for mold issues, your kids are going back to school and you're worrying about, where am I going to stay temporarily while my home's being repaired. So these are kind of all things that we look to advise on. So when you add all of those pressures up, loss costs are increasing dramatically for our insurers, leading many to take significant rate increases or even pull out of the marketplace entirely. So
who makes that decision?
That's something that internally they look at their book of business and they look where they have aggregation and concentration of business and where the losses are coming in. And when you have out in California, you have the brush issues, the wildfire, surprisingly earthquake and things like that aren't as much of a concern nowadays. It's more the wildfire issue. The problem is carriers in California are taking insured losses in the tens, if not hundreds of billions of dollars, to where California is a very consumer-friendly state. So the Department of Insurance won't approve higher than, I believe it's 6.9% rate increase per filing. If you're losing hundreds of billions of dollars and looking to take 6.5% increases on your portfolio, it's going to take you a century to make up those losses. So it's just not sustainable long-term to operate in. So, it's ultimately a business decision to say, for us to remain a viable insurance carrier and remain in business, we have to decide and make tough decisions to potentially even leave or exit marketplaces due to these conditions.
From a competitive standpoint on the carrier side, as carriers drop out due to their loss ratios, I can only see it being an opportunity for other carriers, unless you're saying statewide, it's a loss regardless. It's not.
So you're definitely a business-minded fellow like myself. I think of, wow, what a great opportunity to there's all this business, but everyone is suffering the same issue now. Yeah. So it's not this particular carrier that's been hit; it's everyone, and it's more of a matter of time as the losses continue to come in, where things are going to go. And I think it's going to be some involvement from the state and local government to kind of assist in coming up with a solution to where clients can actually purchase insurance coverage. I mean, we have situations where clients with multi-million-dollar homes are having to go to a direct writer insurer or even go to the California Fair Plan, which is a government-run entity, to get insurance coverage for, $6-7 million homes. So we'll see kind of what happens in that marketplace, but things will definitely kind of shift. So yeah, talking about just kind of going back to market capacity, that's kind of what we're seeing kind of in the space now. So I would say it's definitely the most difficult time we've ever had in the industry in terms of coverage placement.
You brought up government, and I don't want to dive too deep into this, but legislation has a huge impact on some of the advice or planning we provide for our clientele and valued partners of our firm from an estate planning perspective, whether that be the exemption being as high as it's ever been or the potential change to grantor trusts and how that's going to be transferred to future generations. And our planning comprehensively can and will be adjusted dependent upon those decisions and what's implemented. Is that the case with your industry at all? Is there any legislative impact that can affect, I guess, carriers' decisions or product decisions?
Well, the answer is yes. On the spot, if I had to think of something locally that came legislatively that had an impact on our marketplace in this area, I'd have to think about it a little bit. But certainly tort reform and other legislative issues ultimately trickle down to the insurance business, right? So if decisions are being made at the government level, which change the legal environment or building codes or whatever it may be, that ultimately has an impact then on how an insurance carrier would ultimately respond in a claim or how the coverage itself would be worded. So yes, the answer is yes. Just would need to give it a little bit more thought as to a specific example for you.
Oh, that's interesting. What are your client concerns when approaching certain types of protection?
So most agents out there will say it's price, which is just not the case, right? I mean, while price is a consideration, our clients in the high net worth space, they want stability, right? They want to ensure in a really difficult situation, they have someone there for them, a broker who they know they can reach out and speak to, one that can offer them guidance through the process, an insurance carrier who will show compassion and flexibility in settling of their claim, one that's not going to ask for pages and pages of documents, require constant back and forth, or make a challenging situation even more challenging. An insurance claim, you could be with the cream of the crop insurance carrier and broker, and you could still have a very difficult time with a claim. It's just an unpleasant thing to have to go through. So as much as you can improve that process, the better, right? So, and really looking for a carrier that can literally weather the storm by having a strong enough balance sheet to endure a significant weather event. So clients want to be treated like a human being, just like all of us. They want to be treated fairly, promptly, with compassion, and they want to make sure that their broker and their insurance carrier is there for the long haul and offers stability for them.
One of my final questions, and I'll go to, when people ask me, well, what do you do? I say I have the opportunity and privilege to work with very successful individuals and families and people who are passionate about their practice and people who have accumulated wealth over the years, whether by starting a business and investing or inherit it. And we allow or put appropriate planning together to give them the right to make the decision on where those assets should go and should be received when they're no longer here. And I'm truly passionate about that, and so is our firm. To segue into my question for you, what is your favorite part of your work and why?
Well, by far the best part of my job is meeting and working with people of all backgrounds. Similar to you, right? We're dealing with successful individuals and families who have spent their lives building what they have, whether it's a business or a passion or whatever it may be. So I really love building a personal relationship with my clients and getting to know them and their families and their interests and hobbies at a truly intimate level. Insurance can be very transactional in nature. So anytime we can offer more of a true trusted advisor relationship, it's mutually beneficial for everyone. So, and of course, I always love it's rewarding to provide a solution to the client where they can take a deep breath and know they're going to be taken care of in the event of something really unfortunate happening. So that is rewarding in itself. But yeah, definitely the personal relationship I get to have with my clientele is the best part of what I do day to day. And I would also say my platform gives me the opportunity to be more involved in the community. So at Brown and Brown, we regularly participate in activities that support the community. So we established the Brown and Brown Disaster Relief Foundation, which is designed to support the needs of those impacted by natural disasters such as Hurricane Ian or other forms of emergency hardship. So Brown and Brown employees even get to contribute via their paycheck to this fund. So, you don't need to put a ton of money, but if you can contribute a few dollars every paycheck, that, in the aggregate adds up to significant amounts of money to help kind of communities rebuild after a significant event. It's pretty awesome. So, and then really the insurance industry in general is very good about giving back and being charitable in nature. So, there's always opportunities to get involved and support kind of the greater good in the community.
Brian, it's been an absolute pleasure to connect with you. It always is. I really appreciate your time coming in today and sharing the information you did. Obviously, you're extremely knowledgeable on your practice and planning with your firm, and we're privileged to have the opportunity to work with you. And is there anything else you would like to add before we conclude our episode here?
Not that I can think of. I want to thank you again for having me on. And again, this was my first podcast experience. Hopefully not too much editing needs to go on your end. But, I enjoy the opportunity to kind of share some of the things we're seeing day to day. And I would welcome the opportunity to share that knowledge elsewhere, wherever it may be of value. So thanks again for having me out. And hopefully we could do another one of these soon.
This one went so well that Tom would be able to edit this one. So this is good. Thanks again for coming in, and we'll talk soon.
Thanks, Mark.